everyone. Welcome to the Property Wealth Podcast. Today, we're diving into something that could really change the game for your real estate investments. You know, it's all about the concept of real estate professional status and how it can act like a tax loophole for many investors.
Yeah, it's a fascinating topic, Sarah. For those over 40, especially, understanding this can help you maximize your tax benefits and really boost your wealth building strategy.
Exactly. We'll cover how you might qualify for this status, the tax advantages it brings, and some common misconceptions that can trip people up.
And I think it's important to highlight, too, that it's not just for seasoned investors. Even if you're just starting out, this information can be super useful.
Right. It's all about making informed decisions that can lead to long-term success. So whether you're a first-time buyer or someone with a few properties under your belt, there's something here for everyone.
Absolutely. Plus, we'll share some real-life examples to help clarify how this works in practice, which I think will be really helpful.
That sounds great. So if you're ready to learn how to leverage your real estate investments for tax benefits, let's get into it.
Let's do it. So, Sarah, one of the big reasons why understanding real estate professional status is crucial right now, especially for folks over 40, is really about that looming retirement timeline.
Absolutely, Mike. I mean, many people in that age group are starting to think seriously about how they're going to fund their retirement. And with the current economic climate, it's more important than ever to have a solid plan, right?
Exactly. And when you look at inflation rates, which have been pretty unpredictable lately, it's become vital to find ways to protect your wealth. Real estate has historically been a great hedge against inflation.
Right. So for someone who's, say, in their mid-40s, they might be thinking, how do I not only preserve my wealth, but grow it?
Yes, and this is where real estate professional status comes into play. If you qualify, you can potentially offset a lot of your income with real estate losses, which can significantly reduce your tax liability.
That's huge. I remember talking to a listener, let's call her Jane. She was really stressed about her upcoming retirement, worried about her savings not being enough.
Oh, I've heard stories like Jane's many times. She was able to dive into real estate investing later in life and discovered that by qualifying as a real estate professional, she could deduct those losses.
Exactly. So instead of just sitting on her savings and hoping they would last, she was actively working to create a more secure financial future.
Right, and it's not just about the numbers, it's about peace of mind too. For many people, the emotional strain of financial insecurity can be overwhelming.
Totally. When you think about it, real estate can offer that stability. Like, if you own a rental property, you're not just relying on the stock market or a single source of income.
Exactly. And, I spoke to a couple, let's call them Tom and Lisa, who were feeling the pressure to ensure their children will be taken care of after they're gone.
That's such a common concern.
It is. They decided to invest in rental properties not just for their own retirement, but also as a way to create a legacy for their kids. They saw it as a way to build something tangible that could be passed down.
And owning property can really help with wealth transfer. It's not just about having money in the bank, it's about having assets that appreciate over time.
Right. And with the current market shifts, we've seen opportunities pop up in areas that were previously overlooked. For someone like Tom and Lisa, it's about being proactive and recognizing those opportunities.
That's such a good point. And it's also interesting how the market is changing. More people are looking for rental properties, especially with the rise of remote work.
Exactly. So there's potential for higher demand in certain areas, which can lead to increased property values. And for someone over 40, this can mean not only a good investment, but also a source of cash flow that can supplement retirement income.
Yes, and let's not forget about the emotional aspect of financial security. Knowing that you have a steady income stream from rental properties can really take the edge off those retirement worries.
You're spot on. I remember another investor, let's call him Mike too. Funny coincidence. He had a corporate job for years, but as he approached 50, he felt he was missing out on experiences with his family because he was always working.
That's so relatable.
So he started investing in real estate. And not only did he find financial benefits, but he also found he could reduce his working hours.
Wow, that's inspiring. He was able to take back some of his time, which is really the ultimate goal for most people as they age.
Exactly. And it's all about that balance, right? You want to enjoy life while also being smart about your financial future.
And with real estate professional status, Mike could really maximize those benefits.
Definitely. It's a way to create a more sustainable income stream, and the tax advantages can help you keep more of what you earn.
And now that we're seeing economic trends shifting, it's even more vital to be adaptable. Those who embrace real estate investing can pivot more easily when markets change.
Yes, and that brings us to the core strategies that anyone over 40 can start implementing.
Right. Let's dive into those strategies.
So let's dive into some core strategies, Sarah. One of the first things I always recommend is the 1% rule. It's pretty straightforward, really.
Right. The 1% rule. So if you're looking at a property, you want the monthly rent to be at least 1% of the purchase price. Correct?
Exactly. So if you buy a property for $200,000, you should aim for at least $2,000 a month in rent. It's a quick way to gauge whether a property can generate enough cash flow.
That makes sense. And it's a good starting point, especially for those new to investing, right?
Absolutely. But keep in mind, it's not the only factor to consider. You also want to think about the location and the property type. A good area might justify a slightly lower percentage, while a less desirable area might need a higher percentage to make it worthwhile.
Right, because if you're in a hot market, you might not find that 1% rule working perfectly, but you could still be in a good investment situation.
Precisely. Now, another rule of thumb I often use is the 50% rule. This one's about estimating your operating expenses.
So that's half of your rental income going toward expenses?
Yep. If you're bringing in $2,000 a month in rent, you'd estimate that about $1,000 goes to operating costs. This includes everything from property management fees to maintenance, insurance, and taxes.
That's a handy way to quickly figure out your cash flow. But, what if the expenses are higher than that?
Great question. Then, you might need to dig deeper into your numbers. It's essential to analyze your specific market and property type. Some properties, like single-family homes, might have lower expenses, while multifamily units could have higher costs due to more tenants.
Makes sense. And what about the cap rate? I've heard that thrown around a lot in real estate discussions.
The cap rate is another crucial metric. It's a way to measure the return on an investment property. You calculate it by dividing the net operating income by the property's purchase price.
So if you bought a property for $300,000 and it generates $30,000 a year in net income, your cap rate would be 10%?
Exactly. So a higher cap rate usually indicates a better return on your investment. But again, context is important. What's a good cap rate in one market might not be the same in another.
Right, because local market conditions can fluctuate quite a bit. Yeah?
Exactly. And speaking of local conditions, let's talk about deal evaluation checklists. Having a systematic approach can help you avoid mistakes.
Oh, I love checklists. What should be on it?
Well, start with the property's location. Look at school districts, crime rates, and amenities nearby. Then consider the property condition. Is it move-in ready, or will it need significant repairs?
That's key. And how about the financials?
Definitely include financials. Check the price per square foot compared to similar properties in the area. Look at historical rental rates and vacancy rates. Are they stable or on the rise?
So it's really about gathering as much data as possible to make an informed decision.
Right on. And don't forget to evaluate your financing options. Some investors might go for traditional mortgages, while others might look into private lenders or partnerships.
Yeah. What's the difference in those approaches?
Traditional mortgages usually require a good credit score and a down payment, but they can offer lower interest rates. Private lenders might have more flexible terms, but they could charge higher rates. Then, there's partnering. Pooling resources can help you access better deals.
I guess it all comes down to your personal financial situation and goals, right?
Exactly. And don't shy away from creative financing solutions either. Sometimes seller financing can be a win-win for both parties.
That's an interesting option. I can see how that might make a deal happen when traditional financing falls short.
Exactly. Now, let's talk about property types and markets. Different types of properties can yield different returns.
Like single-family homes versus multi-family units, right?
Exactly. Single-family homes tend to have a broader buyer pool, making them easier to sell. but multifamily units can provide better cash flow since they generate income from multiple tenants.
And what about commercial properties?
They can be lucrative, but they come with their own risks. You often need a larger capital outlay, and the lease agreements can be more complex.
So diversifying your portfolio can help manage those risks?
Absolutely. Mixing property types can create a balanced portfolio. So if one sector dips, another might be thriving.
That's a smart strategy. But I imagine there are pitfalls to avoid when getting into this, right?
You bet. Let's transition to those common pitfalls. They can really trip up even experienced investors if they're not careful.
I'm all ears. What are some of the most common ones?
So, one of the biggest pitfalls I see with investors, especially those just diving into real estate, is over-leveraging.
Oh, for sure. It's so tempting to think, if I borrow more, I can buy bigger properties and make more money. But that can backfire, right?
Exactly. I remember this investor. Let's call him Tom. He bought a couple of properties with very little down. He was convinced the market would keep climbing. But then, when it started to dip, his cash flow got tight.
Yikes. So what happened to Tom?
Well, he found himself struggling to cover mortgage payments. And then, the stress really started to pile up. He had to sell one of his properties at a loss just to stay afloat.
That's tough. I think a lot of people don't realize how quickly things can shift in the market.
Right. And it's not just about the market. Bad tenants can really complicate things too. I had a friend who rented to someone without doing a thorough background check.
Oh no. What happened?
Yeah, this tenant ended up being a nightmare. They paid late, then stopped paying altogether. My friend had to go through the eviction process, which took months and cost him a lot in legal fees.
That must have felt like a huge setback.
It really was. And it's a lesson learned. Always, always do your due diligence on tenants. Check references, credit history, and maybe even have a conversation to gauge their reliability.
It makes sense. It's better to be cautious at the start than to deal with the fallout later.
Absolutely. Another thing that comes up often is ignoring cash flow. Focusing too much on the potential appreciation rather than the actual income the property will generate.
Yeah, I've seen that too. People get so excited about the property itself that they forget to calculate whether it's actually making money.
Exactly. I had a client, let's call her Lisa, who bought a property in a really trendy area. She thought, this is going to appreciate like crazy, but the rent didn't cover her mortgage and expenses.
That's a classic mistake. So what did she do?
Well, after a year, she realized she was in the red every month. She had to make some tough decisions, like raising rents, which wasn't easy in a competitive market.
That sounds stressful.
It was. The lesson here is to crunch those numbers beforehand. Know your cash flow, know your expenses, and don't just assume appreciation will cover your costs.
And sometimes, the hidden costs can really sneak up on you, right?
Oh, definitely. You might think you've got everything figured out, then you find out there are property management fees, maintenance costs, and unexpected repairs that eat into your profits.
That's such a good point. I think people often underestimate how much maintenance can actually cost over time.
For sure. I know someone, we'll call him Dave, who bought a fixer-upper thinking he could flip it quickly, but he didn't accurately estimate the renovation costs.
What did he miss?
Well, he ended up needing to replace the roof, the plumbing, you name it. It wasn't just cosmetic fixes. By the time he was done, his budget was blown, and he was stuck with a property that took way longer to sell than he anticipated.
That's frustrating. So how can someone spot these red flags early on?
Great question. I think it starts with thorough research, understanding the neighborhood, the average cost of repairs, and even talking to other investors. Get a sense of what to expect.
Networking can really pay off, huh?
Absolutely. Connecting with others can provide insights that save you from making costly mistakes. Plus, it's all about having a realistic mindset. Don't just focus on the highs.
Right. And timing the market. That's another trap, isn't it?
Definitely. Some investors try to time their purchases based on market trends. They think they'll buy low and sell high, but that's really difficult to do consistently.
I can see how that could lead to missed opportunities.
Exactly. I had a colleague who kept waiting for the perfect moment to buy. He ended up watching prices rise for years while he sat on the sidelines. And when he finally bought, he paid a premium.
That's such a shame.
It is. It's important to remember that there's never a perfect time. The key is to focus on the fundamentals of the property, rather than trying to guess where the market will go next.
So what would you say are some solid next steps for someone who wants to avoid these pitfalls?
Well, first, always keep a close eye on your finances. Have a budget that includes a buffer for unexpected expenses.
That's smart. And doing thorough tenant screenings too, right?
Yes, ideally, you want tenants who can pay reliably and take care of the property. Never skip that step.
And maybe even working with a mentor or joining a real estate group to share experiences?
Absolutely. Learning from others can save you a lot of headaches. And finally, stay informed about the market, but don't let it dictate your every move.
Great advice, Mike. It really sounds like being proactive and informed is key to success in real estate investing.
For sure, and it's all about building that long-term wealth without falling into those common traps.
Well, that wraps up our discussion on the common pitfalls and real-life lessons in real estate investing.
Yeah, and I hope our listeners feel more equipped to navigate these challenges.
Up next, we'll dive into some actionable strategies for building a strong real estate portfolio.
All right, so let's dive into some immediate steps listeners can take, right now, to leverage the benefits of real estate professional status.
Yeah, I think that's crucial. What's the first thing they should do, Mike?
Well, first things first, they should get a clear understanding of their current situation. I mean, it's all about knowing where you stand, right? So taking a look at your hours spent on real estate activities.
Right, like tracking how much time you're actually dedicating to those investing activities.
Exactly. You could use a simple spreadsheet or even an app like Toggle to log those hours. It doesn't have to be complicated, just consistent.
Great idea. And what about finding properties?
For that, I'd recommend checking out Zillow or Realtor.com. They're user-friendly and can give you a good sense of the market. Also, don't forget to use local MLS access if you have it. It's invaluable for finding listings before they hit the mainstream sites.
Yeah, that's a big advantage. And when it comes to analyzing potential deals, what tools do you think are essential?
You've got options like the BiggerPockets calculator or Deal Check. They allow you to input your numbers, run the projections, and see if a deal makes sense financially.
I love how those tools make it easier to visualize the potential returns.
And don't overlook Rentometer. It's fantastic for checking rental rates in specific areas. It helps you ensure your projections are on point.
That's so true. It's all about understanding the market, right?
Absolutely. Another step would be to start analyzing one deal per week. Even if it's just for practice, it gets you in the habit of looking at properties critically.
That's a manageable goal. And for those who might feel a bit lost, joining a local real estate meetup can be a game changer.
Yes! Networking with others can provide insight, support, and even partnerships down the road. You might find someone who's been in the game longer and can offer guidance.
And speaking of guidance, are there any books or podcasts you'd recommend?
Oh, for sure. The book on rental property investing by Brandon Turner is a classic. And if you're into podcasts, the BiggerPockets podcast is packed with stories and advice from experienced investors.
Those are solid resources. It's so important to keep educating yourself, especially in this field.
Exactly. Building those habits, like analyzing deals, networking, and continuous learning, will set you up for success.
So, for someone just starting, it sounds like starting small is key.
Definitely. Just take those first steps. Focus on consistency, and don't overwhelm yourself.
And over time, those small actions can lead to big changes, right?
Absolutely. Remember, it's a journey. Celebrate those small wins along the way.
That's such a good mindset to have. So with all these tools and habits in place, what's next?
Well, I think with these tools in your pocket, you're ready to move forward. It's about taking that first leap and seeing where it leads you.
And that's what we're here to support you with. Now, let's bring this all together.
So, as we wrap up, let's just recap some of the key points from our discussion on real estate professional status, yeah?
Absolutely. First off, we talked about how this status can really open up some tax benefits. Like, allowing you to offset your rental losses against your ordinary income.
Right, and that's a big deal, especially for those of us who are looking to maximize our returns. The time commitment is crucial, though. You need to spend more than 750 hours a year on real estate activities.
Exactly. And we also touched on the importance of documentation. Keeping track of your hours and activities is essential to prove your status, right?
Yeah, and don't forget about the potential for passive loss deductions, which can really help reduce your overall tax burden if you qualify.
Such a powerful tool for savvy investors. And it's all about being strategic with your investments, building that long-term wealth, one property at a time.
Definitely. Real estate isn't just about buying and selling. It's about creating a legacy and financial freedom. It takes time, but the rewards can be incredible.
So if you found this episode helpful, please like, subscribe, and drop a comment with your biggest takeaway or any questions you have. And if you know someone over 40 who's interested in property investing, share this episode with them.
That's right. We're all in this together, building wealth and supporting each other.
Next time, we'll dive into mid-year tax strategies for rental owners. Very timely, especially as we approach the second half of the year.
Can't wait for that discussion. It's going to be super valuable for our listeners.
Absolutely. Thanks for joining us today, and remember, every step you take in real estate brings you closer to your financial goals.
Take care, everyone. We'll see you next time.
Bye for now.